Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. You can find the information from the show on our website at yourlifeafterwork.com, iTunes, and various other places. Obviously, we're here weekly on WILO from 4 to 5 p.m. During drive time, Saturday morning on our flagship station of WQME from 9 to 10 a.m., and Sunday mornings on Shine 99 between 10 and 11 a.m. Consider This really is a show that's much more than just the weekly headlines. We work together to try to give you insights and directions into things that you may want to consider about your financial lives. And the questions come in many directions. You can always reach us on Twitter, hashtag AskBigJoe. And of course, you can email us your questions. Consider this, that's all one word, consider this at yourlifeafterwork.com. We break the show down into what we call 5 critical financial elements. One, always begin with the end in mind. So we start with retirement income. Where is the money going to come from to maintain your standard of living? Number 2, then, is the tax plan that needs to be done each and every year before the end of the year. 3 is the investment policy statement. What's going to keep you from getting caught in a downturned market without paying attention, without having discipline to how you want to respond? 4th is life happens. It's the good and bad and ugly of life, the things that we just normally see that take place. Last but not least is the legacy plan. Everything that we do is all about your life after work. That's the name of our website, yourlifeafterwork.com. We want to take what's going on in the world, keep you abreast of changes that matter. Sure, it's always fun to talk about markets and headlines, but what we really want to do is give you things to consider. So as I said, shoot us an email, consider this at yourlifeafterwork.com. Enjoy the show and keep in touch. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. You are the most important part of the show, by the way. Appreciate it. If you've got a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com. And here we go. So I promised to talk a little bit about accumulation. Remember that first phase, Sherry? It's when you're getting on the airplane.
Yes.
And, and really the driving force of this show this week, and probably a good part of next week, the driving force was the market volatility that's been going on. Now, please keep in mind and understand the rules, right? In case you've missed it, there's a lot of place to get news sources. Right? There's a
Yes.
lot there are more places than there are stocks, I think, to get news information.
Is
right?
it really news though? That's the question.
Well, noise is more accurate, but that's we'll get to that in a minute. My point is this: when I was on Fox Business or on CNBC, back in the early 2000s, mid 2000s, when you'd go to the studios, it would just be full of people. And today they're not full of people.
Full of people doing what?
Research.
Oh,
because,
wow.
Because
Okay.
everybody did their own research,
Now
really.
they don't do that.
And now nobody wants to be scooped. And it's to a large degree, it's a regurgitation of other things that are going on out there in the world. So my point is this: anytime there's any little amount of volatility, they are going to run with that as quickly as they possibly can.
Yeah.
People don't need to watch TV or go to Bloomberg or visit the financial sites when the market is flat. Right? Or just working its way up. Now, with all this volatility, we want answers. Joe, why are materials doing so well? Iron, I looked at iron ore this morning, and it's had three rallies, the last three rallies over the last couple of years, 34%, 39%, 33%. So in order to have a rally that high, it means you had to have let's just call it a falling out.
In between?
Right, in between.
It's not like this just keeps going up.
It looks very much like the stock market back in 1934 when you had these huge, you had huge gains during the Great Depression. You just also had huge drops, right? And so you've got to be very, very careful with stuff like that. But let's pretend like we're on that airplane. We're loaded on the plane, and we're going to start saving and accumulating money. And, I just had she's 26 years old, I think, with two kids. And she said, Joe, this volatility is scaring me already. And I said, you're 26, relax, take a breather.
She's nervous now.
But she's a smart girl.
Yeah.
Right. And this, a lot of you are going to be shocked by what I'm getting ready to tell you. Now, remember, this doesn't help us so much in preservation.
This is accumulation.
This helps us a lot in accumulation, where we're putting money in, and there is a concept that is called dollar cost averaging.
Okay.
Dollar cost averaging says, we really don't know where the market is going to be in a given time. So, you just set up an amount, percentage of income is how we would teach it, and that just constantly goes in and invest inside of the market without worrying about where it is today, the price of it today, the volatility. You pick out the things that you want to own, that you want to have, in your nest egg, and you begin to buy them. Now, I would never tell anybody to be that blind about it.
On your own? You just go in
No. We manage money for people, so no, I wouldn't encourage that.
No.
But yes, your 401k is a form of dollar cost averaging. You've picked the 8 or 10 or 5, whatever it is, mutual funds that you're using, and every month you're putting in $100 or $500, whatever your amount is.
Yeah.
That's dollar cost averaging. Well, here's the scoop. From 2000 and great work again, Eric Nuss. Just want to give you credit for this. When you look at the S&P 500 between 2000 and 2014, so a 15-year period of time, the Vanguard S&P 500 fund earned a paltry 4.1% per year. 4.1. That was your average return over that period of time on an annualized basis. And that's nothing, of course, when you think about inflation and everything else, especially if you're not paying attention to taxes. But it's nothing. In fact, it's nothing more than the return that was generated by Vanguard's short-term bond index fund, which received the same result with 7 times less volatility.
Yeah.
But that's not the whole story.
Okay.
Right? You might think to yourself, what a loss. I've sunk $1,000 into stocks every month for 15 years and have little more than ultra-safe bond returns to show for it.
Yes.
Right? But you'd be wrong.
Really?
You'd be wrong.
Why?
Despite only saving $180,000 cumulatively, so that 15 years, 12 months in a year, $1,000 a month, you put in $180,000, your total ending portfolio balance was $352,202. That's twice as much as you saved for a rate of return on your contributions of 8.5% per year.
How did that work?
That's a good question. How can this be, you say?
Yes.
The S&P 500 did only average 4.1%. but not all of your savings averaged 4%. Some money went in after 2001, after the tech wreck, after 9/11, 2002, one of the worst years in history, 2008, the crisis, 2011, all of when shares were extremely depressed and subsequently earned returns of 12, 15, and 20% or more. That's the benefit of consistently.
So it's the timing of when you put them on.
Not the consistency of it, not picking the dates. Not picking the time.
No, but
I mean, bottom line, the more volatility there is for stocks in dollar cost averaging, the better off you're going to be. Okay? And it works that way. Now, the problem is it does not work for bonds.
Right.
Because they don't have, you need the volatility in order for dollar cost averaging to hit home runs. Right. What you need is a market over a period of time that generally worked its way up. So think about from the left side to the right side, it got higher, right? It doesn't work if the market goes down over 15 years, but you can certainly have bad years. And as long as you're consistently putting money in, this is a really good thing for you. You get into trouble with the other parts, and you get into trouble when you don't recognize that you're not at the preservation stage yet. For a 28-year-old in this case, she's saved up $60,000 or $70,000. That's a lot of money for some people that are 65 years old. She's done a great job, and she doesn't want to see it go away, right? But she's also saving about $15,000 a year now, and when that's happening, this dollar cost averaging part really matters, really takes on its path, if you will. So understand how that concept works. Math is a really, really creative, fun thing to do. And, I was not there when Albert Einstein passed away. Don't want to pretend that I was, but allegedly on his deathbed, he said, I don't know what what the seven wonders of the world are, but I know the eighth, and it's compound interest, right? Because compound interest is just as fascinating as watching these returns with volatility coming in. So here's a general rule. It's my kids would get it wrong on almost every test at Purdue. So I'll give this to you just as a general rule. When you're accumulating, you want your bad returns first. Okay, bad returns first. So when you're loading the plane, you want stuff to be as cheap as it can possibly be. Right. When you are in preservation, you want as stable an average return as you can possibly get to be able to reach your goals and objectives, and so you don't bail out. Try to go to cash, try to time the market. You just can't. That discipline has to stick in there. And when you get into distribution, when you go to land the plane, this is where you cannot afford the volatility at all. And it's one of these things, I can prove it to you with math in the office. You can have a lower average return and have more money at the end than a higher average return with more volatility during distribution, for the same reason that this just worked here in dollar cost averaging is why that volatility while landing the plane will sink your battleship. Forget Monopoly. We've now moved on to another game. Barb and I like Battleship, by the way, but this is one of those things you have to be aware of. And when you think about your statements consistently the same, regardless of what age you are, when you take in no tax consideration, whether it's tax-free, taxable, or tax-deferred, when you just look at it as a lump of money, of stuff that you've saved up, you can get into very, very serious trouble. And folks, do not destroy your retirement by not understanding this. It is not neurosurgeon type stuff, but it is more complex than people believe that it is. It's not as simple as calling your provider up and saying, hey, I need my $2,000 a month, turn the check on, right? We've got to make sure that we're taking it out of the right accounts, the most tax efficient way we possibly can, and just being smart about what's going on. Thanks for the questions and comments. We get really appreciate them. It's nice when somebody shows up in the office that has been listening to the show for a few years. You don't have to wait a few years if you're listening and you like what you hear and you think we might be a good fit. Feel free to give us a call, 800-928-4001. We are happy to talk to you. In the meantime, we're talking about required minimum distributions and helping people understand what's going on in retirement. There is a rules change, and I know, Sherry,
it bugs me like nothing else, because how does the normal person know?
They don't.
I know. That's what I'm saying.
The good news is in the United States, we don't let you do anything that can kill you quickly.
Yeah.
You cannot walk into a drugstore and walk out with morphine without a prescription.
True.
I couldn't even go buy cough syrup. Because,
Oh, I know. It's locked up.
You got people of a bunch of different ages that are, you need weak stuff. You need strong stuff. You need weak stuff. Oh, no. You may be making meth or something. Whatever.
Yeah, it could be making meth.
If I knew how to make meth, I'd be rich and we wouldn't, No, just kidding. Taxi.
Yes.
Y'all understand the point. So we'll let you do anything that kills you slowly. You can buy cigarettes.
Yeah.
Right. And you can manage your own money.
Yeah.
But you can't do anything quickly, right? Then we're going to put somebody in the way. I will tell you that this is a very, very, very complex thing. And there is the curse of knowledge is that you just don't know what you don't know. Mm-hmm. And people often harm themselves because they're not familiar with the complexities. Or, as my friend Barry Ritholtz would tell us, we have the illusion that somebody else is looking out for us. And we're going to talk a little bit about that in
I think that's
in some of the things
prevalent.
that are going on. They've got the example that we use or that he used is, well, you got Mark Sanchez lost $100,000. Famous NFL quarterback, Hall of Fame guy. Not maybe a Hall of Fame, but really good guy. But somebody that profess to have the same faith, same Christian faith. How could this guy hurt me or intentionally harm me? Well, we never know in the end of the day whether it was intentional or not. In this case, Mark was very much taken advantage of and lost a lot of money, but people think, well, they have the same affiliation, whether it's military or whether it's a church or a Christian group. You got to be careful with that. But the other part is we trust the people that we deal with. And I've had people look at me and say, Joe, well, I asked my guy about what you said, and he said it didn't matter. And it's kind of like, well, why can't I ask your guy? Because I'm guessing the questions that I would ask might be a little more pointed than the ones that you might ask, because you don't necessarily know the basis. We believe when we have somebody who's there to take care of us that all things remain equal. And folks, that is just not the case. Across the board. There are very, very important questions or observations that ought to occur. But especially when we're doing this stuff on our own, we have to be very careful. There's none of you listening to the show that would intentionally harm you or your spouse. I don't believe it. I don't believe we wake up and go, what can I do to hurt myself today?
Yeah.
Right?
Yeah.
But there's things that you don't know that are out there, and many of them revolve around that tax return and understanding where they are.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Sherry, we get inundated with a litany of economic terms, numbers,
data,
names, things that are going on.
Right.
And for most consumers, I tell them, to have an idea of the general inputs, but bottom line is most of it is noise. Noise,
right.
Or what my engineers would tell me, the difference between signal and noise is one matters and one doesn't. Just because you've heard it 10 or 15 times in a matter of an hour doesn't mean that it matters more in the world that we live in. Between all of the social media, all of the immediate outpouring of information, you could hear data go very, very, very quickly. Mm-hmm. My point in this segment is to help you as an individual understand that there are some points of data that are economic, and there are some points that are consumer driven.
Okay.
And to be able to understand those differences. So when you hear the word GNP, right, gross national product, More commonly, you'll hear GDP, gross domestic
Domestic.
product. It's a measurement of what we created based on goods and services inside of the United States. And it gives us a way of knowing whether we're, quote unquote, expanding or contracting.
Because we compare from year to year, not because that number in and of itself.
Quarter over quarter from the year before.
Okay.
So
Okay.
the third quarter, versus the third quarter.
Right. Okay.
And yeah, we're trying to get an idea of how that growth is taking place and occurring and whether or not it's mattered. So,
Yeah.
they'll say seasonally adjusted or they'll do one
Right.
of those things. My fun one was in 2011, I think it was. In January, we redid the GDP for 1987. So yes, that was before I started in the career. Yes, before I got married. And we're dealing with more than 25 years.
Yeah.
And they're redoing it now. And
Interesting.
Canada's still our largest trading partner.
Yeah.
One time Canada got the numbers wrong and our GDP was off by more than 1.5%.
Wow.
You say 1.5%. What's 3, 4.5? What makes a difference? Well, when you're dealing with the largest economy in the world,
It's a big deal.
We're talking about many, many, many zeros. So. That doesn't really impact the average family household.
Right.
What the gross domestic product is. It gives the economist an idea of where we need to be, what's going on in some areas, but it doesn't really affect you. CPI, on the other hand, the Consumer Price Index, is a measurement of inflation. Now, if you read my article in the Anderson Herald, you can find it on our website as well at yourlifeafterwork.com. I've talked about this before. There's a difference between goods, hard things that you buy, toasters, blenders, drapes, couches, TVs,
Right.
and services. The barber, somebody mowing your yard. There's a big difference between the two. Cable is a service, for instance, right? The TV is good. What we pointed out is we live in a world that is naturally deflationary. So when you look at the goods that you've bought, the price of goods is actually contracting. They're depreciating. It's cheaper to get stuff made because of national trade deals, things of that nature. On the other hand, services are becoming more expensive. Plumbers are not charging less. Barbers are not
Right.
charging less.
Sure, yeah.
And they're going to continue to rise because there is a greater need, a greater demand than there is a supply of some of those things that are going on.
And they can't be replaced by robots
And you cannot have a barber in China.
No. No.
So you can either shave your head, and I wouldn't recommend that for you, Sherry.
No, I don't want to do
I've
that.
done it for a play.
I know. And it actually worked for you, Joe.
I don't intend to. I won't say that it couldn't happen.
Oh, come on.
But I don't think that it will be there again. But there are different things that matter. Savings rate is one of those things that has nothing to do with any of us individually. It has to do with us collectively.
Okay.
So I'm just going to give you this data real quick, just because I think it's important to keep track of. 21% of us are saving more money now than we did back in 2015. I think that's a good thing.
Okay.
It ought to be more.
Yeah.
Gas prices are dramatically different today than
Right.
they were back then.
Maybe you have more money to
we
save.
should be saving more. Only 17% of us are saving less, according to the poll of Bankrate.com.
Okay.
Bankrate's a really good source to go to when you want to find out what's going on in interest rates. Hourly wages are up 2.6%. That's good, right? That is good. So some of these matter to you, some of these don't matter to you. Now, here's where some of you may say that this is political, and I apologize for that. But the Department of Labor is on my Christmas card list, and they're off. So
They're on and off.
In 1 year, here's what the Department of Labor did.
Okay.
They put into establishment a thing called the fiduciary rule. So,
Which you like.
I love that.
We love that. That's a good thing.
And am I biased? Absolutely.
Sure.
Let's just get that out of the way. Am I biased? Yes.
Yeah.
Did I also build the firm around that? 18 years ago because it's what I believe in through and through? Absolutely.
Yep.
I don't think I should ever be allowed to convince you to do something that's not in your best interest without
Right.
being able to be judged, not on your decision, but me providing the right decision.
And you were ahead of the curve on that. You didn't come late to that party.
We've never done the other.
Right.
We serve as fiduciaries, which
Right.
means I have to treat your money as if it were mine and we were in the same situation.
Sure.
The Department of Labor came out and said anybody who deals with 401ks or IRAs now has to have that same element, if you will, of responsibility and liability. And there's a way out of it. And I can, they call it the best interest contract. So, Sherry, if I was going to sell you a variable annuity or a fixed index equity annuity, if I gave you a contract ahead of time that says, I'm going to show you something in a few minutes, but I'm going to get paid $10,000 if you say yes.
Yes.
I'm thinking the conversations may go a different direction.
Sure,
right?
exactly.
At least I hope they do.
Yeah.
Right? So the Department of Labor has put that into play. I am fully supportive of every single bit of that.
Sure. So why are they off the Christmas list?
Well, they did something else.
What'd they do?
There is a law that when we look at America, obviously there's a huge difference between cost of living in California and New York
Yep.
and Indiana.
Sure.
Right. So, we have built a company where, we pay a lot more than minimum wage. And I mean, we just do,
Right.
provide health insurance,
Right.
provide a 401k, right? And we work a lot of hours.
Right.
It's not easy, especially when I go back, 15, 16 years ago with people who are now my partners.
Yeah.
They believe me, they burned the midnight oil just like I did.
Sure.
To be able to be partners and to be able to get ahead. Right?
That's what you have to do.
So, there's a law that says if you made a certain amount of money, a small amount of money on a salary basis, so
Okay.
that if you went over 40 hours, you had to be paid overtime, even though you were on salary.
Even though you're on salary?
Yeah. Well, now that number has been shifted, and there's exceptions. Healthcare, for instance, is one of those exceptions.
Yeah.
Now the number has been shifted to an income of $47,000 a year and change.
Okay.
Right. So if you make less than that, and you do anything more than 40 hours a week, then all of a sudden you have to get paid overtime.
Even if you're salaried?
Even if you're salaried.
I did not know
so
that.
Understand what's happening here.
Wow.
The people, I wouldn't have had the ability to pay overtime, nor would I have had the time to be able to calculate it, to keep track of it.
No.
I have to pay for a bunch of technology now, right?
Yeah. Oh, yeah.
In order to be able to limit people who wanted to work.
Oh,
right?
man.
It's not, you don't have people who are saying that, I didn't want to work and not be there. Everybody who's part of our FEG family knows a couple times a year we have a group dinner with all of our families that we take care of.
Yeah.
Right. So they can no longer do that, or I have to pay overtime, or they have to leave during the day
to do that
and not be able to be at work in order to be able to have the fun part of seeing the people that you serve and take care of.
That's
all the
crazy.
time. Oh, it gets worse. I'm not done yet.
That's crazy.
One of the young ladies that I went to high school with, and I said young, correct?
Right. Oh, you did.
We graduated together, so she is young.
She's really young. Infant almost.
Grew up in a little town, went to high school together. So
Yeah.
she's up in my Lafayette office. She runs my calendar.
Yeah.
Right.
Yeah.
She's been on Facebook for longer than when she's worked with me. She texts me and tells me things, or whether it's going on with her family or me and Barb and what's going on.
Yeah.
She can no longer text me. After December 1st of 2017, if it has anything at all to do with the business, an email, if I send an email to her, which I send a lot of emails at 2 in the morning if you don't know me very well.
Sure, yeah. Business stuff.
Not because I expect her to return it.
No.
But I'm reading emails and I send
That's
it to her
when you
and say,
go
hey,
through
we
it.
need to get this on the calendar.
Yeah.
I don't expect her to return it.
No.
But the rule is, if she received it, she's expected to have read it. And if she read it, each email is at least 15 minutes worth of time.
And you got to pay her.
And it's not just paying her. This is not about just paying. I understand the coordination of everything that has to go on.
Oh my
so
gosh.
if she wants to put in the time to do what Sarah did, what Adam did, if she wants to put that in so that she can be at another level in the company, the government, Big Brother, just took that away from her, right? I mean, she cannot show her willingness to want to do more than
unless
other people.
you are willing to pay her for that
and track it. So
Man.
Suddenly her emails have to leave her phone. She's not allowed to have them on her phone anymore.
What?
I've got to tell her that she can't text me anymore. Oh, seriously? You can't. And the Department of Labor did this. Now again, somebody living in LA that is on salary that's making less than $47,000 a year. Maybe this was viable. But to do this across the board, it really, honestly, Department of Labor, you hurt people by doing it. We don't take advantage of anybody.
No.
But there are many times where we'll have people work maybe an extra 45 minutes or an hour 1 week, and then we give them the time off. it can't even be the same pay period. Sherry.
So okay, let me ask.
This has got to be the same 40-hour work week.
Okay, because what if she personally feels like she needs extra time? She just, the learning curve. Let's say she just starts a job and the learning curve is such that she needs to put in 50 hours in order to do 40 hours worth of work.
It can't.
So
either we have to agree to 10 hours of overtime.
Or she has to lie and tell you she's not working.
Or, which we don't do lies. So
well, I know. I mean, she has to.
But what that means is that very much limited.
Wow.
And it's not just here. I mean, I don't think they understand small business.
No.
And how it works. I think they just took away part of what makes America great.
Well,
somebody who's willing to do more than somebody else is to try to be able to, to get ahead in terms of effort or education.
I don't know anybody that sticks to 8 to 5. I mean, literally, I don't know anybody.
No, there are people, but there's not many people here.
No, but let's just think about this. You can't get an email. I get emails 24/7. Yeah.
I cannot communicate with her anymore that way after December 1st of this year.
Wow.
And it's, that to me is just preposterous.
That's crazy.
And, some of you out there may be hearing, well, you've got no right to email her at 10 o'clock at night. I don't expect her to answer me at 10 o'clock
It's
at night.
Because you might forget at 8 a.m.
forwarding a message that's on to her.
Yeah.
But I don't know how, and again, we may not be like normal businesses, but we're all collected. We're all through social media. We're all, through personal.
Yeah.
We call the FEG family a family for a reason. It's a
family, yep.
And so I understand all businesses are not the same. Got that. But folks, this is some of the stuff that we're up against. This did not hurt me as a business owner.
It hurts her
near as much as it's going to impact them in their future.
Yeah.
And that's just not right. That's a sad situation in my mind. So there you go. You were on my Christmas card list, and
now you're off.
Now you're off. And I'm not fickle. I'm not.
Takes a lot to get off your Christmas card list.
To me, those two just. One was so extremely right, and one is just, what were you thinking?
Well, it really takes away if someone has ambition to really be better at their job and learn something and build something, it takes that away.
So other than the personal rant, what's this have to do with you? Well, here's what it has to do with you. Some businesses just became less productive.
Yeah.
Some businesses lost some of the efficiency. Anytime they put any of these government stuff in, our cost of making sure that this is all done it has zeros behind it. This is not $100 fix. This is not $1,000 fix. This is over $10,000 a year. That they just took to put in a rule for us to make sure that we're compliant with. That most of the people that I have here would say, we don't want to be compliant. We want to be able to do what it is that we're doing in our happy little family.
Yeah.
So,
wow.
Anyhow, I have issues. But hey, there's that. So you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. You got a question or comment, you can shoot me an email. Consider this at yourlifeafterwork.com. Sherry, have you ever wanted something and then got it and then kind of weren't so sure you wanted it after all?
I don't know that that's happened to me a whole lot. Actually,
doesn't happen to me a whole lot either. But
yeah,
I'm kind of I'm as I read this, I'm a little bit kind of, I'm a little older, a little wiser now.
Really?
I'm
so ready to hear this.
All right, so there are deals in the marketplace, and you'll hear them that are called private or public deals.
Okay.
Right? Public deals are like mutual funds. Right, individual equities that are publicly traded.
Yep.
Publicly means it's not controlled by a small group of people, and anybody who has the money can invest in the deal.
Okay.
Okay. Then there are private deals, like, the Financial Enhancement Group's got 4 owners, but we're privately held. You can't show up and say, Joe, I want to see your books.
Yeah.
You can't say, Joe, I want to buy 5% of your company.
Yeah.
You can say that. You're just not going to get an answer that you're probably wanting, right?
Sure.
Those are private deals. Well, every now and then, you will have a company that wants to raise capital.
Sure.
But doesn't want to go through all of the regulations and everything else that would be required to become publicly traded.
Okay.
Maybe they don't want to be publicly traded at all, or maybe they're startup company. So last year, the big news, and I'm sure that's what perpetuated the story. The big news last year is we had over 100 unicorns, and unicorns were companies that had been in business for less than 10 years that had a market capitalization of more than $1 billion. These were private companies that had raised capital and were now thinking about going public. Right?
Okay.
And if you ever hear anybody talk about a Reg D investment, Regulation D is an investment where you're able to put money in, but it's not publicly traded. Number one risk, obviously, is liquidity, right?
Yeah.
You can't get the money back out very easily. But there's a whole slew of risks, right?
Sure.
When there's less regulation, there's more opportunities for scams, cons, everything else, whether or not the money can be handled, those kind of issues that exist outside of there, right? Now, accreditation is what you have to be able to invest in one of those Reg D placements. Accredited is what we call it. It's an accreditation. Totally in the past, based on resources. You had to make more than $200,000 a year, for instance, 3 of the last 5 years, 300 if you're married, or you had to have $1 million worth of net worth, excluding your home, and technically not even your retirement accounts were supposed to count. Okay. And I always made the argument, said, hey, guys, now this is a little unfair. You got somebody in Madison County, Indiana, making $150,000 a year. They're technically not accredited, but they're probably doing pretty well for themselves. Oh, yeah. Somebody in LA making $250,000 a year is they're eating beans and Wheaties and, trying to figure out how to survive.
Right. Yeah.
But they're accredited and the guy here is not. I said, we need to create a fairer standard because there are business opportunities that are out there that some people need to be able to invest in. Well, as we started off the discussion, Congress listened.
Really?
And
there's a story right there.
Well, yeah, no kidding. Worse than that, 347-8. That was I mean, you talk about not being any no fight at all. 347-8 would expand the definition of an accredited investor. Under current rules, a person had to have a net worth of $1 million or make $200,000 or more annually. The legislation would allow anyone now who has a securities license.
Okay.
Right. So we've got clients that have securities licenses, by the way.
Sure.
Yeah. I manage the money, but they have securities license.
Yeah, I get it. I hear the irony.
Having a securities license doesn't make you a guru in the financial world.
Sure.
If you see somebody who says they have a Series 6 or a Series 7, or that means they passed a test. Right. That does not mean they understand, what we do on a daily basis. It just means they passed a test. So that part scares me, right? Or who has professional knowledge and experience related to a specific security to participate in the private placement. The later description would apply. For instance, the author says, this scares me to death, the doctor who wants to invest in a medical device manufacturing startup. Okay. Now, does the doc understand medical devices more than me?
Sure.
Most likely, right? Is he going to understand more than most of the people who are putting money into the deal? And the answer is most likely, right? Does that mean that the doc has the necessary experience to determine whether or not the business is being ran correctly?
No.
Whether or not yes, it's a great device. Maybe they're selling like hotcakes, but that doesn't mean that they necessarily know how to do the rest.
Right.
And it's, so I'm mixed on this. Do I think the rule over the $1 million should be changed? Yes. Do I think the doctor understands the medical device issue? Yes. So I'm kind of in the middle of the road. The vote certainly wouldn't have been 347-8. When I look at this, I'm a little further away from that.
Than
what's going on.
It was so unanimous.
And so what concerns me is you're only allowed to have a certain number of people that invest in a Reg D account, or if you will. You're allowed to have a certain number that aren't accredited.
Yeah.
And everybody else has to be accredited.
Right.
And so Sherry, you could invest in a grant writing company. If I wasn't accredited, I couldn't. right?
Okay, yeah.
But does that mean that if you sit down and you explain to me the grant rating process, gave me a few books, put me on a board somewhere, that I couldn't now argue that, well, I do have, who is going to regulate what I know and what I don't know, and whether this is really a good idea for me or not? It's a very interesting conversation in terms of what's going on. Here's my point, however, that I want you to keep in mind. Remember the fiduciary focus, and if you missed it, you can get segments off of the internet or iTunes anytime you want to go backwards. Our show is on yourlifeafterwork.com. That's our website for the Financial Enhancement Group. You can go there, and anytime you see the fiduciary focus, I'm going to be talking about these 4 things: risk and volatility, fees and expenses, taxes both today and tomorrow, and real return. Those are the 4 things that, as a fiduciary, I think you have to pay attention to. And I don't believe the majority of people truly understand the risk of illiquidity. Right? Can't get my money back.
Until they need to, then they understand the risk.
Well, but the number of sales that I'm seeing in indexed equity annuities right now, and there's a proliferation that's taking place.
Interesting.
And the lockup. This poor lady came to us, and lots of kids. And sit down, and it really didn't understand her money at all, but was sent to this guy and down in Indianapolis, and went down, and essentially he had locked all of her money up in about 5 different annuity programs. She asked how much she could take out. Or he asked, how much do you need? She said it, and he said, we can do that. So set it up. She got income for 9 years, and then all of a sudden one day the check didn't come. And she didn't understand that the contract ran out of money. So we had to work with her to help her take about a 40% reduction in income. And so that she would still be able to have enough money to be able to go. Just because you have a license, does not mean you have integrity.
No.
It doesn't mean that you know how to do planning, right?
Yeah.
So anyhow, when I look at that fiduciary focus and I look at this rule, there are a lot of people out there that will come to me to try to get me to put my clients in things that shouldn't even be allowed to exist. The businesses aren't that well thought out. They don't have the right people being able to run them. And everybody gets caught up in periods of time where the economics looks really, really strong.
Right.
And that's what it looked like last year in the internet, or in the technology space. And a big part of it's this biotech stuff. The example they use in that medical device, right? And I understand when a doc says, "Hey, I want to be able to invest." I get the point. I just worry about it overall. So anytime somebody approaches you with something where liquidity is an issue, remember that is part of that risk and volatility thing.
Sure.
And you really want to think that through. And it's, we're more than willing to have a cup of coffee with you, sit down and discuss what that really means and how it looks inside of your future. Very, very, very important to do.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along. Hey, we're in this middle of this conversation, if you missed us on the side of the other break, about the phases of finance that I like to call. And I use an airplane because I try to remind people that we're on a financial journey.
I like that
And
analogy.
So you go through the accumulation. That's when you're boarding the plane.
Yep.
You're getting things in the right seats, getting the luggage where it goes. So
Yep.
everything's evenly distributed. That's saving the right percentage of your income. It's making sure that you're building tax diversification. So you have some money that's in a Roth, some money that's in tax deferred, perhaps some money that is after tax. It's very, very important as we progress to understand how the tax code works and why all three of those areas are important.
Yeah.
Eventually, we get to a point where what you're saving is not as important as what you've already saved.
Right.
It usually happens from 48 to 55 if you've been a good saver. What the nest egg that you have is much larger than what you're contributing this year. And it's the only time that average return matters, which is why we're very, very careful about dealing with average returns and what's going on. And we're going to talk about Bill Miller here in a minute about that, and Peter Lynch for that record. Eventually, though, that you're going to go to land the plane. And landing the plane is when you want to make sure that you've got the right tax diversification. So what I'm paying attention to is how much taxes am I paying on the average dollar that I pull out of an account?
Right.
And secondly is the volatility. Market going up and down is not an issue in preservation as long as you can hold out the storm and you think you're in good
Right.
shape. And during distribution, that's different. If I spend $1 when the market's down, it never gets a chance to go back up
Right.
and do what it needs to do. So
Yeah.
the two of them have to come into play to be able to work together. Now, when we look at this stuff and help people try to understand, the common question is going to be, what percentage should I be saving?
Sure.
How am I doing along the way?
Right.
There's a lot of assumptions that
There is no one right answer.
There's not. There's
Right.
not. But preservation is one of those stages where people really get into trouble. So average return means exactly what it says. What is the average, right? So I started January 1st, and what's my average return 10 years later?
Right. The average over a period of
Over a
time.
period of time. Market's going to go up, market's going to go down. That is true.
Right.
The reason we take the time to make sure that people are disciplined enough and understand how their money's being managed. The reason I have a whiteboard, right, is I do want to teach.
Sure.
But I want you to understand what is going on. When we look at this, stocks have produced an annual return of 9.9% over the last 20 years.
9.9%.
The average investor has received 5.2%.
9.9 seems really high to me.
I know it does, but that's because the average investor has gotten 5.2.
Well, how's that work?
Because people put money in when the market is high, and they pull money out when the market is low.
So when you say average investor, you mean like individual people as well
all
as
the retail accounts, Morningstar,
everybody.
Dalbar, Fidelity, Schwab.
Got it.
All of the research points
Average
to that.
together. Okay.
And it is it's a very, very sad statistic. But
Yeah.
it's from a behavioral finance standpoint, put on my academic head back in Purdue days. You put that on and you ask the problem in terms of what's going on. And again, this is over an average return.
Yeah.
So when you start looking at people during distribution, it's not the average return that matters. It's the volatility. And the volatility could have even been worse because people do tend to put money in pretty much at the exact worst time, right? They tend to put money in when the market is high, or they pull money out when the market is low.
Yeah.
Market goes back up, then they go back in. It's
an emotional decision.
it becomes very, very problematic for people.
Fear of missing out.
Yeah.
Fear of missing out on the good and the bad, I
It
suppose.
is. So in the market terms, what we talk about is a thing called capitulation. And capitulation means fear. And
Yeah.
It almost always goes around the sell side. They capitulate it out of the market, right?
So capitulate it sounds like an action verb, like you're going to do something
Yes.
because of your fear.
Out of fear.
Right,
Purely out of
okay.
fear. So in 1997, 98, you had the irrational, exuberant speech that came from Greenspan, right?
Yep.
In 96 or 97, you had the Asian flu, the crisis that occurred over there financially that almost brought down the part of the East Coast. Nobel Prize people who got it wrong in terms of what was happening. You had a lot of stuff that was going on, and people got out of the market primarily because they were worried about Y2K and the market valuations. But we were watching accounts go up 5-10% a month.
Wow.
So when somebody had a $500,000 401k, there were a lot of them that became $1 million, in a couple of year period of time.
Yeah.
And you got through Y2K that first week in January. and people couldn't take it anymore. Y2K didn't happen.
Yeah.
That was their great white hope. See, I knew I was right. You fool. You had all of your money in the market.
Yeah.
You lost it all.
Yeah, yeah.
That's not what happened.
Right,
It went the other way. And so we watched this huge influx of money in January and especially February of 2000 of people who capitulated into the market. They couldn't take it anymore. The fear of them being left behind,
Missing out, yeah.
had them go into the market.
Wow. So they bought at high rates.
And then March 10th, the tech wrecks begin to take place. And that loud sucking sound, that was a blowing sound, but the loud sucking sound is your 401k, going straight downhill. Again, I'm not a mutual fund fan, so I don't have to hide anything. There's no mask here.
Yeah.
Right? The average American who owned one mutual fund owned 11 of them. You went back to 1999, and we used to call them the Five Horsemen. Microsoft, Cisco, Dell, Intel, and MCI. And remember, you young folks don't even know what MCI is.
I know.
Bernie Ebbers was the CEO. He's still in prison. It was as big of a scandal as Enron was in many, many different ways. And we all know what happened there if you were alive in the early 2000s. So, it was a problematic thing. But the average person who owned a mutual fund owned 11 of them because people believe they're things. They're not. They're wrappers. They hold stocks and bonds. And when you own Microsoft in 10 places or 11 places, if you put money in and that fund manager had to buy more Microsoft, it drove the value of Microsoft higher everywhere. So you used your own leverage to drive your other funds higher for all intensive purposes. And, even though people thought they were diversified, they weren't. Even looking at the S&P 500, Sherry, which shocks people to death, even looking at the S&P 500, January 1st of 2000, 40% of the value of the S&P 500, because it's based on market cap, was in technology and telecommunications. Negative net earnings, 40%. So you'd see these people at General Motors that had all of their money in the S&P 500 fund and go, hey, I'm diversified among 500 different companies.
No.
Yeah, but not evenly. Right?
Yeah.
And 40% of what you have of that $500,000 nest egg that you built, 40% of what you have, that $200,000 of that is simply in technology and telecommunication stocks that have negative net earnings.
Wow.
This is not going well for you. Right? So how does this play out? Well, two examples. There was a guy named Peter Lynch, just to understand how average returns can get you into trouble. Peter Lynch managed the Magellan Fund for Fidelity. For many years, you couldn't buy a Magellan Fund because money managers do better when they're smaller. We have a commitment at the Financial Enhancement Group not to go above $750 million in assets because all of the written paper will tell you, every white paper, all the research tells you, you go above that and you begin to harm the people that you already take care of.
Really?
Yeah, every bit of it. And the average mutual fund, by the way, has $3.2 billion.
Oh my gosh. Okay.
So
and that's why, well, we don't have time for that. But
at $750 million, we're done taking in new money from people. We'll just take care of the people that we have, and it is it is what it is.
Right.
But when you're smaller, you have the ability to move. When I buy something, it's why they always have to report what Berkshire Hathaway, what Warren Buffett does.
Right. Yeah.
It moves the market. Right?
Sure.
So
yeah.
Apple's had from the period of time that Berkshire added more, Apple's stock has gone up because people know they can't get in and out. They've got to be committed longer term.
Sure.
Right?
Yeah. Yeah.
So when you're smaller, you have the ability to be more nimble, if you will, to be able to navigate what is going on inside of the world. And so as we look at this, as we move forward, you can see some of the big movement that takes place in the market when some of the larger places go. Well, Peter Lynch got bigger. His average return was more than 20% a year, right? Over a 20-year period of time. And Fidelity wrote this big story about him. Well, Sherry, let me help you out here. If you're up 100% in 1 year and you're at 0% the next 4, what's your average return for 5?
You're up 100% and then 0 for 420?
Yeah, 20%.
Yeah, so
right?
you look good on paper.
So if you put money in that first year, you were a rock star. If you put money in the other 4 years, you're sitting on dead capital.
Sure,
right?
yeah.
That's what happens
when
fund managers are smaller and things are going on. In the sad case, because in my career, Peter started a little bit before me. Bill Miller, just found up his 35th year at Legg Mason. And he actually beat the Standard & Poor's Index 15 straight years. So not an average. He beat it 15 years in a row. And
so if you went with him, you'd be good no matter what of those 15 years you got in.
Yes. Well, better than the S&P 500.
Right,
Remember,
better.
the S&P
Yeah,
had
yeah,
some
yeah.
huge negative years.
Sure, right.
2002,
But
2008.
relatively speaking,
Right.
okay.
Relatively speaking, he did better than other people who were
Sure.
trying to manage.
So that's important.
It is. And, his fund got up to about $38 billion. He was small for a long time.
Okay.
Right? Which gave him that ability to navigate, maneuver.
Yep.
Got into 2008 and made some wagers that he thought were right based on value. Rule number one, the market can remain stupid longer than you can remain solvent.
Wow.
You do not have the ability to outfight the forces of the market. So when we come back and we talk about breadth and some of the things that are going on, it's just like in the late 90s when people can say, this makes no sense. You're accurate, but the market can be stupid longer than you can remain solvent.
Wow.
And you've got to, from your financial situation, you have to be very, very aware of that because capitulation, emotions, things are huge, huge issues. So here Bill Miller is at 66. He's out at Legg Mason. The fund went from about $38 billion down to about $1 billion. As people withdrew their money, it's, what have you done for me lately? But you really got to feel, he took it hard in 08 and a couple other periods of time and had to step down as the manager. It's why diversification is important, not just with one school of thought, but with multiple thoughts that are going on, paying attention to the taxes and paying attention to the percentages. Even when we have a company that we like, and I guess for the record, I need to say we're Long Apple. I've been Long Apple since 2006, when long simply means we own it. But when you look at this, you've got to understand when Apple got higher, we sold some Apple shares, and people got mad at us. Why would you sell my Apple, right? Because as a money manager, you're always a loser.
Yeah,
right?
yeah.
Either you sell it and it went down. Why didn't you sell it all?
Yeah, right.
You
Sell it and it goes up.
You bought it and it went up. Why didn't you buy more, right? So it's one of those things. But that's being a fiduciary. It's treating your money.
It's what you would do.
As if it were my money and we were in the same situation. Even when it doesn't feel good, you got to do the right thing for the discipline to make sure that you get to where it is you want to go. And that's to be able to maintain your standard of living as long as God leaves you on this good old green earth. So, well, each and every week we send out the opportunity for you folks to send in questions. It usually provides a question with a little bit of detail. And so Sherry is going to play our Vanna White.
I'm Vanna today.
She's going to read the question and give us a little bit of detail. And then I'm going to make her answer it.
No, I was going to say, here's the deal. I have the question. You have the answer.
We'll flip a coin.
No. Okay. All right.
Go ahead.
This is an interesting question. Does every average person have to pay Social Security tax and file taxes? Now, that's the question. Does every average person, I define average, but does every average person have to pay Social Security tax and file taxes? And the information is, I know someone who's in their 70s and has not paid Social Security tax or filed taxes since they retired. They have no other income. Is it mandatory?
Okay, so you do not have to file taxes if you do not owe. Okay. So with Social Security income, if you look at your tax return, it is about 60% down the page, maybe 70% down the page. There's a column for you to put the amount of Social Security benefit you received in the middle, and then off to the right in the ledger is the amount of income that is taxable. Right?
Okay.
So the maximum amount under current law that your Social Security can be taxed is 85%. That's the maximum amount of the contribution or the money that you get that is taxable.
Okay.
And it's based on the amount of other income that you have.
Okay.
So if somebody was having some income tax withheld from their Social Security, so they were automatically paying into it, or automatically paying taxes, and that was more than enough to cover what they would have owed, or they would have been entitled to a refund even perhaps, then no, they don't have to file. Right?
Okay.
They could be wasting money very easily. Right? Now, where we get into this conversation and question, though, does the average American pay taxes? Anybody who has earned income on line 7 of their tax return, and there's other places that you can get it as well, all pay into Social Security while they're working. That's the money that goes to what we call FICA.
Right. Yeah.
That's 7.65% of everything that you make.
Yeah.
That comes out of your check. And then your employer matches the other half. If you're fortunate enough to be self-employed, like we are, you got to pay both sides at 15.3%.
Jeez.
The other part of the tax is the marginal bracket, and that's the one where you if you think stair steps start to go up.
Yep.
And the average American does not have anything on this. It's 54% of Americans don't pay any taxes on the marginal side.
Yeah.
But 100% of Americans pay taxes
Social
on earned
Security.
income.
Right. Okay.
So there you go.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com.